Hello, everyone, and welcome to Resolve's 12 Days of Investment Wisdom miniseries, where Michael Philbrick, Adam Butler, Jason Russell, and myself, Rodrigo Gordillo, will explore timeless, evergreen principles that will help you and your clients achieve long-term investment success. From the importance of asset allocation, thoughtful portfolio construction, and maximum diversification, our aim is to offer you a comprehensive framework for a more thoughtful investment approach that may change the way you view the complex arena of investing altogether. We hope that you enjoy this series as much as we enjoyed putting it together.
Mike Philbrick, Adam Butler, Rodrigo Gordillo, and Jason Russell are principals of Resolve Asset Management. Due to industry regulations, they will not discuss any of Resolve's funds on this podcast. All opinions expressed by the principals are solely their own opinion and do not express the opinion of Resolve Asset Management. This podcast is for information purposes only and should not be relied upon as a basis for investment decisions. For more information, visit investresolve.com.
Welcome back. And day 3, think about the portfolio construction. Why are there so many bets in the asset allocation space? Why we think this diversity should persist? And then how might we think about constructing that diversity in a very thoughtful and balanced way? And I'll turn it over.
So the way we think about diversity is in terms of what are the macroeconomic drivers that are influencing the returns for the different asset classes. And we can break this total sum of economic environments down into 4 regimes by dividing them along the axes of inflation and growth. And so if you sort of think about a typical two-dimensional axis, you've got inflation going up and down, you've got growth going left to right. So the upper right-hand quadrant, you've got high growth and high inflation. So you've got an inflationary growth regime. Bottom right, you've got a disinflationary growth regime. The top left, you've got an inflationary stagnation. So you get inflation and negative growth surprises. And then the bottom left is a deflationary bust. And there are fundamental reasons why different asset classes should rise and fall, thrive and fail in each of these different macroeconomic environments. And so if you think about, what is fundamentally designed to do well during an inflationary growth environment? Well, emerging market stocks. Why? Because typically emerging markets are more likely to produce commodities. Commodities are also doing well in an inflationary growth environment. Real estate, both domestic and global, does well in that type of environment. What's an inflationary growth environment? Well, think about sort of the 2000 to 2000 and mid-2008 period where you had a rise in real estate around the world, a big run in emerging markets and commodities, right?
And gold.
The decoupling BRIC countries, right?
Those the BRICs, exactly. Yeah, exactly.
And this is where growth is just outstripping the rise in inflation, right? So the growth is sustainable and it's causing further demand in commodities. It's like a positive feedback loop.
Mm-hmm.
Yeah, we don't always see that during an inflation environment, right?
Yeah, that's correct. So if on the other side of that coin, if growth starts to fail or you just don't have growth while at the same time you're experiencing inflation, whether that be wage inflation or whatnot, then we get into the period like the 70s.
Mm-hmm. Yeah, like look, you have in the 70s, you had stagflation, right? A period where this is what everybody fears today and has been fearing since 2008, right? There's runaway inflation, and in a period of runaway inflation, you're going to have high correlation between bonds and equities, and you're going to be in trouble. And that's exactly what we saw in the 70s.
Right.
We had a series of recessions while the US dollar was getting pummeled and inflation was runaway. In a traditional portfolio, 60-40, you wouldn't be able to do much. But once you start introducing asset classes like gold, commodities, right, where you're making 1,400% returns in that same period where bonds and equities did 0, and 800% returns in, I think it was 1,400% for gold, 800% for a commodity basket. Clearly, there's a place for that, for those asset classes. And today, we have the benefit as well of tips. I mean, talk about a more fundamental asset class that you can predictably say, if we have runaway inflation, then tips are going to be offsetting that inflation.
That's right. The government is covering that.
There is no
risk.
we can predictably say that in this type of environment, these are the asset classes that are going to thrive. What's tough is identifying what environment we're in at any given time.
Exactly.
So 2 separate things, but they are structurally designed to thrive in different environments.
Yep.
And then we have periods like 2008.
Yeah, where obviously it was a deflationary bust. We've got a massive drop in inflation. At the same time, we have a huge kick in the teeth for growth. And stocks fall because they're sensitive to growth. And what does well during deflation? Well, bonds are fundamentally designed to do well during a deflationary environment. And of course they did. The
return of capital.
Becomes
not
the
return
priority
on capital.
And if it's deflationary, you got cash being the best bet against that. So you have protection from cash. You have positive returns from treasuries.
From duration.
And then if you want to include it as an asset class, whatever the reserve currency at the time is, that's where safety goes, right? So money flows
the whole point of deflation is everything's getting cheaper.
Mm-hmm.
And so if you can just preserve your purchasing power, you're actually winning. I mean, that's one of the things in the Great Depression that was interesting is that deflation was rampant. And so if your portfolio actually treaded water,
your $100 bought a hell of a lot more.
Way ahead.
Yeah, it was a huge achievement.
For sure.
So just to summarize that, there's these structural relationships based on fundamental economic properties. I would also caution listeners that these relationships are obscured by noise on a daily and weekly fractal of time, but can be very clearly observed on more quarterly, annually, and
yearly,
sort of
and even
3 to 5 year.
Right?
Correct. So I just caution you, it's a day-to-day thing. They can be shrouded in noise, but just step back, look quarterly, look at yearly, and they become much more obvious.
There's no shortage of people pointing out the fact that things can correlate altogether in a short period of time, which is 100% true. But what we're discussing is the structural long-term relationships of these asset classes that you can see better over time.
In the end, their fundamental properties are what's going to win out
over the noise.
Over the noise, exactly.
Right.
But
so what's the point of this is now we've basically identified from a fundamental perspective why it is that working in the arena of asset allocation provides us with higher breadth. We gave you the number. And we identified the fact that in this arena of asset allocation, you have a ton of diversification. Here's why. So we just explained why that is and why it's likely to continue to persist, why we can depend on that over the next 100 years in the portfolio construction process. Okay, so
because
here we
they're
are.
linked to fundamental properties of macroeconomics, right? So now you've got 12, 13 major global asset classes. You've got everything from foreign and emerging bonds to diversified commodities and gold and stock indexes from different regions. How do we put all these pieces together, right? I mean, we want to create a diversified portfolio. How do we do that?
Well, just equal weight it.
No. Market cap weight. Everybody loves a good market cap weight.
Sure.
The old Vogel approach. Let's do that. What happens then?
Well, yeah. So let's think about market cap weight is approximately 50-50 global stocks and global bonds. It's tough to figure out what the so-called, I'm air quoting here, but market cap of commodities or gold are. Is it based on throughput or is it based on total amount in storage? Not to get too far off topic there. Let's just assume 50% stocks, 50% bonds, approximate global market portfolio.
And we'll link to a blog piece that actually walks through the sharp global market portfolio allocations. If you want to replicate this, we actually show it there with the holdings.
So, if you want to create it, you can create it. But the reality is just sort of thinking about it from the perspective of how diverse is this portfolio that's got 50% global stocks and 50% global bonds. Well, one of the missing pieces here in terms of constructing a diversified portfolio is that diversification is a combination of both diversity and balance. And the reality is that the global stock side of that 50-50 portfolio is profoundly more volatile than the global bond side. And so the risk of that portfolio is massively skewed to stocks. So to quantify it, there's a few different ways to quantify it. One easy way is let's regress the returns on that portfolio on the returns to just the stock side of the portfolio. And you find that the stock side of the portfolio explains 90% plus of the total variability in returns over time.
So let me provide some context here. I think this is an easy example for people to wrap their minds around. So what this means, if we have some two asset classes, bonds and equities, that where one dominates the risk of the portfolio, right? 90% of the risk comes from equities. What that means is over the next 10 days, let's assume that bonds make money for 10 consecutive days and equities lose money for 10 consecutive days. In a 50-50 portfolio, 9 out of those 10 days, that portfolio will have lost money with equities.
That's right.
And so that's a good way of understanding that the direction of that portfolio, the outcome will be nearly wholly dependent on that equity side of the portfolio.
Exactly. So let's just link it all together here, right? We can go right back to the beginning. So asset allocation is useful because you've got a wide variety of independent bets. Those independent bets are sustainable because they're directly linked to fundamental economic properties. And our objective should be to maximize diversification because diversification is directly linked to the breadth of a portfolio, the number of independent bets in the portfolio. And we care about that because a portfolio that has more independent bets, more diversification, has a higher expected risk-adjusted performance over time, right? So just sort of connecting all the dots here.
Preach.
Amen.
So how do we measure the number of independent bets or the amount of diversification in a portfolio? I mean, we just talked about the fact that a 50-50 portfolio of stocks and bonds is 90% stocks. Is it diversified? Well, no, right? It's basically one bet, 1.1 bet, or just call it one bet, right? So how can you take these 12 asset classes that have diverse correlation properties and create the most diversified portfolio? Well, I mean, there's a way to quantify the amount of diversification in a portfolio. It's called the diversification ratio. And you can actually maximize the diversification ratio. Let's take a simple example. You've got two equity indexes. Those equity indexes are essentially perfectly correlated. You hold both of those equity indexes in the portfolio. And let's say that both of those equity indexes have a annualized volatility of 10%. Well, when you put them together in a portfolio 50-50, that portfolio has an expected annualized volatility of, you guessed it, 10%, right? Now let's assume you've got an equity index and a bond index. You're going to hold them both in a portfolio so that they're risk balanced. How many independent bets? And let's assume that they're uncorrelated. Well, they're uncorrelated, so there's now two independent bets. What is the volatility of that portfolio? It's 7%, right?
Right.
And so the way we measure the diversification in a portfolio is we take the weighted average of the volatilities of the portfolio constituents. In this case, you've got two constituents, each with a 50% weight. So the weighted average of those portfolio constituents is 10%. At the same time, the portfolio volatility, because the stocks and bonds are uncorrelated, is 7%. So the diversification ratio is 10 over 0.7. I'm going to say that's, I think, 1.4. So now you've got that diversification ratio is 1.4. So now we're able to quantify the amount of diversification in a portfolio, and it allows us to use optimization to create a portfolio, let's say of our 12 or 13 global asset classes, that is maximally diversified by finding the weights that maximize that diversification ratio.
Yeah, well, just go back to that two asset class example. You said 50-50, right? That's an equal weight portfolio?
But equal risk.
Okay, you said equal. I just wanted to clear up because you could have made the example of an equal weight portfolio divided by an equal weight portfolio level. So it's the accounting for diversification on the denominator. And when you do an equal risk contribution, that changes. Doing the global market portfolio and doing that math, you will get less independent bets from the global market portfolio that's dominated by equity risk.
Measurably less diversity.
And using all of those 12 different asset classes than you would by making sure that the maniacs aren't taking over the asylum, that you have equal risk contribution across each individual asset class. Through many methods of optimization, we can get to that risk balance. That risk balanced approach actually increases the amount of diversified bets using the same asset classes.
Exactly, yeah. Depending on how you put the portfolio together, the weights of those assets in the portfolio will dictate how diversified that portfolio is, and we can quantify that using the diversification ratio.
Right. So I'm going to just jump in here, folks.
Yeah.
This is all written out in some of our pieces. So I think where would we find some of that? So Skis and Bikes would have some of that math in it.
There's really good simple examples in the Skis and Bikes paper, and then some of our recent articles on portfolio optimization. We really get into the nuts and bolts of this, and highly recommend it for those who want to go a bit deeper.
That was heavy. It was awesome.
It was heavy.
Want to give everybody a chance that if you like that, go to the papers link.
But just to bring it all together. So we have, going back to day 2, we talked about skill multiplied by breadth. Breadth increases by working in the asset allocation arena, asset class arena. That once we're in that arena, we can do better by simply being there in a global market portfolio weighting. And then we can improve that by weighting them more efficiently, by weighting them from a risk quality perspective. And so that's one way to do it. And in terms of diversification, in order to optimize this, what we are measuring, what are the things that we're measuring, right? We're measuring the correlations between these asset classes. We have to make some assumptions. So you can decide, you can have a heuristic and saying like generally bonds and equities have X amount of correlation. So we're going to weight this based on these long-term estimates of correlation. And you're going to get some improvement there than just doing a global market portfolio. But as we get more active and as we're able, if we have confidence and we have a system that allows us to have confidence in
we have estimates, portfolio agility too.
Portfolio agility, right, allows us to maybe update our estimates of correlation as they change. Because we all know that long-term correlation between bonds and equities, gold and equities and so on, don't hold.
It's the joke about the economist with his head in the oven and his feet in the freezer, and on average it's just right. And we know that sometimes the correlation between stocks and bonds is positive, sometimes it's negative, and that'll have a profound impact on the diversification properties of the portfolio if you're not changing that through time.
As an example, the 1970s we talked about earlier, stocks and bonds had negative real rates of return and were correlated
to each other.
Exactly. The efficient frontier in that case is a straight line.
That's right.
There is no diversification.
Right. So if
you limit yourself to stocks and bonds.
Correct.
If you're an individual that invests in these long-term assumptions and invests for 100 years and it's really for the next generation, then it's not that big a deal. You're going to have a pretty poor period in the 70s, but you're going to survive it. We have the ability to be agile. We get paid to get better estimates. So if we can get better measures of correlation and update those measures as we go along, we are now even going to be able to provide that excess diversification, that excess breadth more consistently.
Actually, a good example of that is in the most recent article that we published on the force multiplier from diversification. We analyzed the number of independent bets based on the long-term average correlation estimates between the 48 different futures markets.
Right.
But if you roll through time, because of the changing correlation estimates, then the average of the rolling number of bets is very substantially larger than the number of independent bets that you get from just using the very long-term averages. So there are advantages to examining the current state of diversification and maximizing the number of independent bets as you go along based on contemporaneous estimates as opposed to just using long-term estimates.
All right, folks. So that's what we wanted everybody to take away from this, right? That, again, focusing on the breadth side of the equation, what are steps that we can take on portfolio construction perspective in order to push the boundaries of maximizing our diversification, maximizing our breadth. And we're going to leave
maximizing our expected risk-adjusted performance.
Because of that. Because it acts as a force multiplier on your edge.
Exactly.
Now that we have gotten there, we wanted to kind of keep it there. We want to keep it as simple as possible for this session on asset class and portfolio construction from a long-only, globally diversified portfolio. But in the next round, we're going to talk a little bit about pushing that boundary even further using factors to create more breadth in the portfolio. Factor sleeves and so on.
And we'll talk about our popular bet with Warren Buffett.
Our Warren Buffett bet that was never.
Let's fact check that.
He was so afraid he just couldn't pull the trigger.
He couldn't.
Exactly. He wouldn't even return our calls.
He ignores bets he doesn't want to take.
Thank you for listening to our 12 Days of Investment Wisdom mini-series. You will find all the information we highlighted in this episode in the show notes at investresolve.com/12 days. You can also learn more about Resolve's approach to investing by going to our website and research blog at investorresolve.com, where you will find over 200 articles that cover a wide array of important topics in the area of investing. We also encourage you to engage with the whole team on Twitter by searching the handle @InvestResolve and following Adam, Mike, and myself. If you're really enjoying this series, please take the time to share us with your friends through email, social media, and if you really learned something new and believe that our series would be helpful to others, we would be incredibly grateful if you could leave us a review on iTunes. Thanks again, and see you next time.
Exactly.
Now that we have gotten there, we wanted to kind of keep it there. We want to keep it as simple as possible for this session on asset class and portfolio construction from a long-only, globally diversified portfolio. But in the next round, we're going to talk a little bit about pushing that boundary even further using factors to create more breadth in the portfolio. Factor sleeves and so on.
And we'll talk about our popular bet with Warren Buffett.
Our Warren Buffett bet that was never.
Let's fact check that.
He was so afraid he just couldn't pull the trigger.
That's right.
He couldn't.
Exactly. He wouldn't even return our calls.
He ignores bets he doesn't want to take.
Thank you for listening to our 12 Days of Investment Wisdom miniseries. You will find all the information we highlighted in this episode in the show notes at investorresolve.com/12 days. You can also learn more about Resolve's approach to investing by going to our website and research blog at investorresolve.com, where you will find over 200 articles that cover a wide array of important topics in the area of investing. We also encourage you to engage with the whole team on Twitter by searching the handle @InvestResolve and following Adam, Mike, and myself. If you're really enjoying this series, please take the time to share us with your friends through email, social media, and if you really learned something new and believe that our series would be helpful to others, we would be incredibly grateful if you could leave us a review on iTunes. Thanks again, and see you next time.